Welcome back to the Deep Dive. Today, we are taking on a really fascinating story from the financial world. We're looking at Bank of America, or BAC, and specifically their fourth quarter 2025 earnings, which came out on January 14th, 2026. And this was a quarter that, well, it had everything. It was like a perfect operational storm hitting a political hurricane head on.
It really was. And that's what makes this such a crucial case study for any investor. You have this fundamental paradox. On one side, the bank's actual performance, it was a clean beat, as they say. Every metric looked fantastic.
Just firing on all cylinders.
Exactly. The financials showed a bank that was durable, growing, incredibly efficient. But then, the market's reaction.
A complete bloodbath. The stock dropped about 4.8%, one of its worst days in months, right after posting these great numbers.
And that paradox right there is the entire story. It's this classic battle between retrospective success, what they did, and prospective anxiety, which is what the market thinks they might face.
So the financials are saying management is at the peak of its powers.
Right, but the political risk, specifically this proposal from President Trump to cap credit card interest rates, it just completely and violently repriced the stock's future.
Exactly. So our mission today is to deconstruct this quarter for you. We need to figure out precisely where the bank did so well, and more importantly, why those amazing achievements were just completely overshadowed by this external threat.
We're going to structure this analysis into 5 distinct parts, almost like 5 slides in a presentation, to give you total clarity on this disconnect.
We want to show you how a single piece of proposed legislation can sometimes matter more than 3 months of world-class execution. So, let's jump right in. Now for slide 1. The at-a-glance scorecard. This is the high-level dashboard for Q4 2025, and it really defines this paradox of the beat and the drop. So the first thing, the main headline, is always earnings per share, the EPS beat. Bank of America reported diluted EPS of 98 cents. Help us put that into context. Was this just, squeaking by the estimates, or was it a genuine surprise?
Oh, it was a decisive win, a really high magnitude beat. The analyst consensus was in a very tight range, somewhere between 95 and 96 cents.
It's not a lot of wiggle room in the expectations.
None at all. So that 98-cent figure, that's a beat of anywhere from 2.1 to over 3%. But the really crucial part is the historical comparison. That 98 cents is an 18% increase year over year from the 83 cents they reported in Q4 of 2024.
Hold on a second. 18%. 18% year-over-year earnings growth for a bank the size of Bank of America.
Yeah.
That's almost unheard of. I mean, we were talking about a GSIB, a global systemically important bank. That kind of growth signals something really significant is happening under the hood.
It absolutely does. It suggests that all those past investments in technology, plus the higher rate environment, were still flowing really forcefully to the bottom line. The momentum was much stronger than analysts predicted.
And the revenue side of the story was just as strong. Total revenue, net of interest expense, came in at $28.4 billion.
Which, again, comfortably beat the Wall Street forecast of $27.55 billion. So you have a 3.1% top-line beat, which perfectly mirrors that EPS outperformance.
Just a clean sweep.
It is, and the top line expanded 7% year over year. What's important here is that the drivers were diversified. This wasn't a one-trick pony. You had strong net interest income, which we'll get into, great fees from global wealth management, and then this huge surge from sales and trading. That was the adrenaline shot for the quarter.
Okay, so let's reconcile one thing. Net income rose to $7.6 billion. That's a very solid 12% increase year over year. But you just said EPS grew 18%. That's a 6 percentage point gap. Where does that difference come from?
And this is a textbook example of really confident capital management. The entire difference between 12% net income growth and 18% EPS growth is the impact of their share repurchase program.
The buybacks.
The buybacks. Management was incredibly aggressive in buying back their own stock this quarter, which reduces the number of shares outstanding. And since EPS is just net income divided by the share count, when you shrink that denominator, the EPS growth rate gets a huge mathematical boost.
So that 98 cents per share is really a signal. It's management saying, we think our stock is cheap, and we are so confident in our future earnings that we're shrinking the company's ownership base.
Precisely. It's a bold strategic move. And paradoxically, it's a move the market completely ignored because of that regulatory threat.
Right, so let's shift from the quantity of the beat to the quality. Why do analysts look at these numbers and call it a high-quality beat?
The quality is all about one thing: positive operating leverage. This is like the holy grail for any business, especially a bank. It just means your revenue's growing a lot faster than your expenses are.
So you're becoming more efficient as you scale.
Exactly. For BAC, we saw 7% revenue growth against only 4% expense growth.
That 3-point spread might sound small, but for an organization this massive, that translates into billions in efficiency gains, doesn't it?
It's huge. It means they're not just selling more, they're selling more at a lower incremental cost. It's proof that all those years of heavy, painful investment in digital technology are finally paying off in real management discipline.
And the sources show this wasn't some artificial one-time gain. It was driven by real customers, real organic growth. Where's the evidence for that?
Well, you start on Main Street. The consumer bank added 680,000 net new checking accounts in 2025.
Wow.
And that metric is so powerful. A checking account is the anchor product. It's what gives them the low-cost funding, the data for cross-selling. It's the gateway to everything else, from a mortgage to a Merrill Lynch account.
So they're building the foundation for future income streams right there.
They are. Then you look at the other end of the spectrum, the high-margin wealth business. GWIM, the wealth management unit, attracted $20 billion in net new asset flows in one quarter.
20 billion.
That is the purest form of growth in that business. It guarantees recurring fee revenue, which the market loves because it's so stable.
And then the cherry on top was the trading alpha from global markets. That division had its 15th straight quarter of year-over-year growth.
Which is just unheard of in a business as volatile as capital markets. The fact that their equities revenue surged 23% tells you they weren't just riding a wave. They were actively taking market share in really sophisticated areas like derivatives and prime brokerage. That's real alpha, which makes the entire beat undeniably high quality.
Okay, so now we have to face the central paradox. How does a company deliver this kind of powerful, high-quality 18% earnings beat and then watch its stock plummet almost 5%?
It's a stark lesson that the market sees certain regulatory risks as, well, almost existential. The drop was a repricing of future risk. It completely disregarded the past performance. The main catalyst was all the political noise around President Trump's proposal to cap credit card interest rates at a flat 10%.
Let's break down the economics of that.
Yeah.
Why is a 10% cap so devastating for a bank like BAC?
So for a massive card issuer like Bank of America, the entire credit card business is built on high margins to cover high risks. It's unsecured lending. Just this quarter, they had consumer net charge-offs, that's defaults, of $992 million, nearly $1 billion lost in 3 months from people who didn't pay their bills.
So the interest rate isn't just profit. It's a necessary buffer to absorb all those losses that they know are coming.
That's it, exactly. The rate has to cover the cost of the money, the operational costs of running the business, a huge risk premium for expected defaults, and then finally the profit margin. For a lot of their customers, especially in the subprime or near prime space, a 10% cap is way below the actual break-even cost of lending to them.
So if that cap happened, you would just gut the consumer banking segment, which, as we said, is their most consistent earner, generated $3.3 billion in net income this quarter.
The market modeled that risk in real time. They saw that a huge chunk of that $3.3 billion comes from card interest. If that's capped, the profit vanishes. The bank would either have to subsidize risky borrowers or, more likely, just cut off credit entirely to millions of people.
And the sell-off hit the whole sector. The BAC was seen as particularly vulnerable because of its huge consumer base.
Absolutely. The market essentially said, we don't care that you just delivered a 14% return on capital. If this cap passes, your future returns are fundamentally broken. It was a huge regulatory discount slapped on top of a beautiful operational premium.
There was a secondary factor too, right? Something that kind of added fuel to the fire. The relative weakness in investment banking.
That's right. The cap was the big story, but the soft numbers in global banking gave the bears some confirmation bias. Investment banking fees were only up 1% year over year to $1.7 billion.
Which looks pretty weak when you hear competitors like JP Morgan and Goldman Sachs talking about a big rebound in M&A and IPOs.
It does. It suggests that maybe BAC lost a little market share in the deal recovery. So while their trading floor was on fire, the advisory and underwriting side was lukewarm. It wasn't the main reason for the drop, but it definitely didn't help the narrative.
Okay, we've set the stage. Operational success clashing with this existential political risk. Let's go deeper. We're moving now to slide 2. Profitability analysis, the rate cycle turn. This is all about how Bank of America defended its margins. NII, net interest income. It's the beating heart of a commercial bank, right? It's more than half their total revenue. The big fear coming into this quarter was that NII was going to shrink.
And they just completely defied those fears. On a fully taxable equivalent basis, NII hit $15.9 billion. That's up 10% year over year, and it beat the consensus estimate. Even more importantly, their net interest yield expanded to 2.08%. That's an 11 basis point improvement. They're making a wider spread on their money.
So the big question for everyone listening is, how? How did they manage that when everyone was worried about deposit migration? Customers pulling their money out for higher yield accounts.
They did it through three key mechanisms that really highlight the power of their franchise.
Okay, let's take them one by one. Mechanism one, fixed rate asset repricing.
Right. This is a powerful tailwind built right into their balance sheet. Think about all the low-rate loans and bonds they bought back in 2020 and 2021.
When rates were near zero.
Exactly. Well, those low-yielding assets are maturing now, and as they get that cash back, they're reinvesting it at today's much higher interest rates. The CFO, Alistair Borthwick, was very clear about this repricing tailwind.
So it's like an automatic built-in profit booster that will keep working for a while.
For years, potentially. It's locked in. Now, mechanism two is simpler. Volume growth.
Right. Profit is rate times volume.
And their volume was up. Average loans and leases grew 8% to $1.17 trillion. So even if the rate spread had been flat, they're earning it on a much bigger base of assets. You combine the wider spread with more volume, and you get that 10% NII growth.
And finally, mechanism three, which to me is the most impressive, deposit stickiness.
This is the one that truly validates the franchise. Even with online banks and money markets screaming about 5% yields, Bank of America's average deposits grew. They grew 3% to over $2 trillion.
That's amazing. It defies pure economic logic.
It proves that for millions of customers, the convenience, the safety, the digital tools, that's all worth more than chasing a couple extra points of yield. The trust in the brand is immense.
And that stickiness preserves their low-cost funding base, which is their ultimate competitive advantage, isn't it?
It is. It's what allows them to defend their margins against almost anyone.
Let's talk about the other side of the profitability coin.
The efficiency.
The efficiency ratio, how much it costs to make a dollar of revenue.
And this is another area where management just executed brilliantly. They drove that ratio down from 63% a year ago to 61% this quarter.
So almost a 200 basis point improvement. That's significant.
It is, because it proves that revenue growth wasn't just being eaten up by rising costs. It was flowing down to the bottom line. It's real discipline.
Their total non-interest expense did go up 4%, but that's much slower than the 7% revenue growth, which is that positive operating leverage you talked about. What was in that cost increase?
It was mostly what you'd call strategic costs. They specifically cited investments in people, brand, and technology. So that includes wage inflation, which is unavoidable, but also critical spending on things like cybersecurity and marketing to get those 680,000 new accounts. These are investments in the future.
But there was also a little bit of a tailwind helping them on the expense side, right? A non-recurring item.
That's a very important point for comparison, yes. The expense line got a nice benefit from a reduction in the FDIC's special assessment. After the regional bank failures in 2023, the FDIC hit all the big banks with a special charge. That charge was a major headwind in previous quarters, so having it reduced this quarter made the year-over-year comparison look particularly good.
Okay, finally on profitability, let's look at the ultimate test. Returns on capital. How did BAC do?
They did extremely well. Their return on average tangible common shareholders' equity, or ROTCE, came in at a very robust 14%. That's up from 13% a year ago.
And ROTCE is the metric that investors and regulators really focus on. Why that one specifically?
Because it strips out all the intangible stuff, like goodwill from old acquisitions. It focuses only on the hard, tangible capital the bank has to hold against its risks. It's the purest measure of how efficiently they're using shareholder money.
So what does a 14% ROTCE tell us about a bank like this?
It tells us they are creating real economic value. The estimated cost of equity for a bank of this size is probably in the 10 to 11% range. So if they're generating 14%, they're earning a significant 3 to 4 point spread above their cost of capital. That's the definition of a healthy, value-creating institution.
And their return on assets also improved. Tax rate is stable. The whole profitability picture is just immaculate.
It is. And that just brings us right back to the paradox. The market saw this world-class execution, and because of one political headline, priced the stock like none of it mattered.
And this is where it gets really interesting. Let's dive into the component pieces of the bank to see who did the heavy lifting. We are moving to slide 3, segment performance, Main Street versus Wall Street. We have to start with consumer banking. It's the foundation of the whole company, but it's also the segment that's right in the crosshairs of this political risk. How did it do?
Performance was stellar. It delivered $3.3 billion in net income on revenue of $11.2 billion. And the efficiency ratio here is just world-class, 51%.
51%. So it only cost them 51 cents to generate $1 of revenue in that massive business. That is incredible.
It's the payoff from decades of building scale. Their average deposits were nearly $1 trillion, $945 billion, which is up 31% from before the pandemic. That low-cost funding is just a fortress.
And that efficiency is tied directly to their digital push, isn't it?
Oh, completely. The goal is to get people out of high-cost branches and onto the low-cost app. And the numbers show it's working. 69% of all their sales were digital. They have over 41 million active mobile users. Digital logins surged to 4.3 billion. Every one of those is a transaction that didn't require a human teller, which defends that 51% ratio.
But we can't ignore the risk. You mentioned the $992 million in charge-offs. This is where the rubber meets the road.
It is. That $3.3 billion in net income is strong, but it's fundamentally threatened by that 10% credit card cap. Investors know that if you regulate the core product's margin away, the whole engine of that segment just seizes up.
Okay, let's move to Global Wealth and Investment Management, or GWIM, the asset gatherer.
GWIM continues to be a crucial stabilizer. It delivered $1.4 billion in net income, revenue was up a strong 10%, and its pre-tax margin expanded to 28%.
Why do investors value the wealth business so highly?
Because the revenue is capital light and it's recurring. Asset management fees, which are just a percentage of client assets, jumped 13% to $4.1 billion. That revenue is predictable and doesn't require the bank to hold tons of regulatory capital against it.
And they're still growing that business organically.
In a huge way, they added $20 billion in net new assets in the quarter. Total client balances hit a record $4.8 trillion. That's trillion with a T. It shows they are winning new clients and keeping the ones they have. It's a fantastic, high-margin anchor for the firm.
Now we get to global banking, which includes the investment banking unit. This is a relative weak link, right?
Undeniably. The segment was healthy overall, $2.1 billion in net income, but the IB performance really stood out for the wrong reasons. Total IB fees were up just 1%.
1%, when, as we said, peers were signaling a big rebound in M&A. That's a disappointment.
It raises some questions. It suggests they captured a smaller piece of the pie as the deal market started to recover. It might mean their strength still lies more on the commercial lending side than in pure advisory.
So if IB was flat, what kept that segment stable?
It was all about global transaction services, or GTS. This is the plumbing of corporate America, cash management, payments, that kind of thing. Treasury service charges were up a steady 10%. It's a sticky, low-volatility business that provides a really important ballast when the more cyclical IB business is weak.
And that brings us to the final segment. If global banking was the lagger, global markets was the division that basically saved the quarter's growth story, the true alpha generator.
Absolutely. The Global Markets division was the hero of the quarter. They delivered $1 billion in net income, driven by total sales and trading revenue of $4.5 billion. That's up a massive 10%.
Where did that explosive growth come from?
Almost entirely from the equities trading desk. Equities revenue just skyrocketed. It was up 23% to $2 billion. This was a huge outperformance versus their peers.
So they were definitely taking market share.
No question. They expertly capitalized on the market volatility, especially in complex derivatives and in serving their hedge fund clients. It was an operational masterclass.
And the fixed income, currencies, and commodities side, FICC, that provided the stability.
That's right. FICC revenue grew a steady 2%, which isn't explosive, but in that world, steady is a sign of really good risk management. They generated consistent returns without blowing up. The strength in global markets was the critical factor that offset the weakness in IB and pushed the total revenue number over the top.
So we've seen the operational strength and the political challenge. Let's turn to the safety net. We're moving to slide 4, financial strength and balance sheet, the fortress. This is all about BAC's ability to weather any storm. In banking, capital is everything. Let's start with the CET1 ratio.
Their common equity tier 1 ratio was very strong at 11.4%. To put that in perspective, the regulatory minimum with all the buffers is around 9.5 to 10%,
So they have a huge cushion.
a gargantuan cushion. It's over $200 billion in absolute CET1 capital, a true fortress.
And they're using that strength to return a ton of cash to shareholders, which feels like a direct statement to the market.
It's an act of extreme confidence. In this quarter alone, they returned $8.4 billion to shareholders, $2.1 billion in dividends, and a staggering $6.3 billion in share buybacks.
That $6.3 billion buyback is essentially management saying, we think this 4.8% drop is ridiculous and we're putting our money where our mouth is.
They are betting their own capital that the long-term value of their 14% ROTCE is going to win out over the near-term political noise. It's a huge vote of confidence in their own resilience.
What about liquidity? Their ability to pay their bills on time.
They are nearly unshakable on that front. They have average global liquidity sources of $975 billion.
Almost $1 trillion in cash and near cash assets just sitting there.
That's right. It's nearly a third of their entire balance sheet. It's the ultimate insurance policy against a panic or a funding crisis. It means they never have to be a forced seller of their assets.
And the ultimate source of that liquidity is still those $2 trillion in sticky deposits.
Exactly. That's the natural differentiator that most competitors can't even dream of matching.
Okay, what about credit quality? This was a huge worry all through 2025. Did things fall off a cliff?
No, actually, we saw stabilization, which was a huge relief to the market. Their provision for credit losses was $1.3 billion. That was flat compared to last quarter and actually down from a year ago. It suggests their worst-case models for a recession haven't come true.
Now, total net charge-offs were $1.3 billion, and we know most of that was from the consumer side. But what about commercial real estate, specifically the office sector, which everyone is panicked about?
This was a critical data point, and it was really good news. Commercial NCOs actually decreased by $94 million, and the bank explicitly said this was driven by lower losses in the CRE office sector.
Wow, that flies in the face of the narrative that the entire office market is just imploding overnight.
It does. It signals that while the sector is definitely under a lot of pressure, a well-managed bank like BAC can handle it. It suggests the crisis might be a slow burn rather than a sudden collapse, which gives them time to work through the problem loans. It was a huge positive for the stability of their balance sheet.
Okay, we have a really clear picture of the bank's operational health and its fortress balance sheet. Now let's look forward. We are moving to our final analytical section, slide 5, management outlook and strategic direction, the road ahead. What did they say is coming in 2026?
Management gave some very clear financial guidance for the year, but it's all based on the assumption of a soft landing for the economy.
What's their forecast for net interest income, the core engine?
They expect full year 2026 NII to grow by a pretty robust 5 to 7%. That forecast assumes that the repricing tailwind we talked about, plus some modest loan growth, will be more than enough to offset any headwinds from potential Fed rate cuts.
And they're doubling down on efficiency as well.
Oh, absolutely. They explicitly targeted another 200 basis points of positive operating leverage for 2026. They are committed to keeping expense growth well below revenue growth.
So with a stable tax rate, the guidance on paper looks fantastic. Another year of strong growth.
If they're left alone to execute, yes, the operational path looks great, but that if left alone part is, well, it's everything.
CEO Brian Moynihan sounded pretty upbeat about the U.S. economy.
He was very bullish. He cited the resilience of consumers and businesses as the reason for his optimism, which is what underpins that loan growth forecast.
But right after that, he had to address the elephant in the room.
He did. He acknowledged that the regulatory environment and tax and trade policies are coming into sharper focus.
Which is classic CEO speak for, we are very worried about what's happening in Washington.
It's his diplomatic way of saying that the single biggest risk to all of their carefully laid plans is entirely political. It's that credit card cap proposal. He's confirming that the market's fear is his fear too.
So if you put it all together, their strategy is just to execute perfectly while this giant storm cloud hangs over them.
That's it. Their official priorities are the same as always. Drive core growth, gain market share, improve profitability. But the risks are really in two buckets now. You have the structural risks, like ongoing wage inflation and the cost of tech upgrades, and then you have the one big one, the legislative risk of that 10% cap.
And the market has already shown that's the only risk that matters to them right now.
It's the binary event that could change everything. So management's job in 2026 is twofold. Execute flawlessly on the numbers and lobby like crazy to neutralize that political headwind.
So what does this all mean for you? We've seen Bank of America deliver a really rare performance, a diversified franchise that just proved its operational excellence. Global markets stepped up when investment banking lagged. NII defied all the fears. Operationally, they absolutely won the battle of Q4 2025.
But that violent stock drop shows a chilling truth about the banking sector right now. Strong fundamentals can be completely secondary to political risk. The entire story for BAC stock in 2026 is probably going to depend as much on what happens in congressional committee hearings as it does on their own income statement.
Right. The bank won the battle, but the war for 2026 is just getting started. And this brings up a really provocative thought for you to consider. Their capital return was so aggressive, so optimistic, $6.3 billion in buybacks. So what happens if that regulatory war intensifies? Does that fortress balance sheet, with its 11.4% CET1 ratio, really give them enough of a buffer to keep up those buybacks and dividends if that credit card cap actually passes? That is the financial tension that will define this bank for the year ahead. We want to remind you that this report is for informational purposes only and does not constitute financial advice, an offer to sell, or a solicitation of an offer to buy any securities. All investments involve risk, including the loss of principal. The analysis contained herein is based on data available as of January 14, 2026, and is subject to change without notice. The author and the publisher have no obligation to update this report. Past performance is not indicative of future results. This report was generated by AI. Like and subscribe to StockAnalytics.ai YouTube channel. Unfortunately, we have been demonetized from YouTube, so we have now shipped off to our StockAnalytics.ai website. For $5 a month, users will get exclusive access to the S&P 500 and NASDAQ 100 libraries, as well as video requests.